if you're a Shopify store and you're thinking about selling, you have to watch this video, because if you don't understand the process to build to sell, then you're gonna get a really shit deal and you're probably gonna lose out millions. So let's dive into it. How to sell your ecom brand for big bucks for dummies. Okay, so there's kind of 3 stages to this video, and it's really important that you watch all of them. Stage number 1 is basically having you actually understand what the fuck enterprise value means, how to create value in the business, finding the right buyer, and then like talking about a little bit about like how to structure the deal in your benefit, and some other things to kind of like look out for. So let's dive into it. So enterprise value, right? I did not understand this until this year, believe it or not, right? And I've been in ecom for like 3.5 years, and I had 0 clue on how valuations work, because I just thought, yeah, like, you know, it's a multiple of EBITDA, but I didn't understand like the underlying mechanics of valuing a company until earlier this year. So if you think about company valuations as kind of like this equation, right? But your valuation of the company equals the future profits that it's predicted to generate multiplied by a discount, right? So why would I, for example, like if I want to purchase a company, I want to buy it for a price that I think I would make a profit, right? So that profit is the size of the discount. And how you work out the size of the discount, well, that's simply the probability of achieving said profits divided by the time taken, aka the opportunity cost. Meaning that, let's say I were to buy a cash flow entity that generated 1 million EBITDA per year, right? Now, if I just leave it as it is and run it in the current way, there's a 50% chance that it's going to go bankrupt in the next year, right? So you see how by that probability of it going bankrupt, or the business stopping to function or stopping to churn out profits, the valuation goes down because I'm taking on more risk when I purchase that company, right? And then also time taken, aka the opportunity cost, right? So obviously I'm spending capital to purchase cash flow. Now, what is the opportunity cost of that cash? Meaning that the longer time it takes, the higher the opportunity cost, therefore the bigger the discount size. So if you think about it as like a mathematical relationship, the size of the discount is inversely proportional to the multiple, aka the higher the discount size, the smaller the multiple, right? So if you don't understand what that means, comment your questions in the comment section and I will answer every single one, because this is something that's super fascinating to me, because it's something that I learned recently and I want to share it with you guys. Now, the general ranges of multiple for ecom is 3 to 12x of EBITDA. If you're wondering what EBITDA is, just think about it as profits. Like EBITDA means earning before income, taxes, dividend, a bunch of shit, basically. What it ultimately comes down to is it means profits. Just think about it as profit in your, right? So for example, if you're a company that's doing about $1 million a year in profits, right? Then that means your e-commerce brand is going to be worth between $3 to $12 million, because the multiplier is 3 to 12x, right? Now, if you're wondering, wow, Boyan, that is a huge ass range, right? And as I said earlier, it's the discount size, right? So obviously if it's a 12 million company, then the discount size is not very big at all, and like future profits is incredibly high, right? Whereas if it's a $3 million company, then that either means your future profits is relatively low or the discount is very high, right? So what actually affects this probability, you ask, right? Well, first of all, is your company relatively automated, or like, you know, you have SOPs and teams for everything, or is it still primarily founder-led? You can kind of like test for this. One way to test for this is if you just like take a 2 to 4 week holiday in your business and see what happens. This is the best way to test it, because if you come back and everything's a shit show, then you'll know very quickly that this is very much so founder-led, right? In terms of having automated teams, again, you know, if it's managed by you, the founder, then again, it's more so founder-led, right? So another way to test this without risking your whole business going to shit is quite simple actually. It's basically just having your team members and your senior management hop on the calls with potential buyers rather than yourself, and having them speak about the company as opposed to you presenting the company and all that stuff. Another really, really big factor, and this affects your probability of achieving said profits, it's basically how differentiated your product is, aka like the barrier to entry, right? So for example, if you're selling, I don't know, like athleisure wear or something along those lines, or like maybe you're selling I don't know, like mascara or you know, like any commoditized products that you can think of, right? The product is not super differentiated, meaning the barrier to entry for your category is not that high. Whereas, for example, if you're selling something like a personalized supplement subscription, right? That means your product is pretty differentiated, meaning that it's going to be quite hard for someone else to set up your exact same supply chain, right? Meaning the barrier to entry for that category of goods is higher, meaning your future profits is higher because there's more retention involved, like your lifetime value goes up. Channel diversity. Are you relying only on Facebook ads for your revenue? If you are, then you do not have channel diversity. Meaning that if Facebook goes wrong or Meta for some reason fucks up, right, the probability of achieving said profit goes down massively. So that means, essentially, if you don't have diversified acquisition channels, then the probability of you achieving said profits goes down because you're incurring more risk, aka bringing down the multiple of the company. Do you have any asymmetric advantages in your supply chain? Meaning, you know, like, can someone else just go to your supply and get the same shit made, right? Do you have IP protection? Meaning, is it trademark? Do you have copyrights? Blah, 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 patents, da-da-da-da-da. Do you have flexible overhead? Meaning, like, do you have long-term contracts with your employees? Or maybe you have, like, vendor contracts with different agencies, whatever. If you have flexible contracts, great. That means you can basically fire everyone and lay off the entire team so that you're not incurring any additional liabilities. Should there be a downturn in the business cycle, right? There's also like debt and liabilities. Like if you have a shit ton of debt, obviously that's going to affect the valuation because it's basically like it's a huge minus on the balance sheet. There's also different like equity structures. Like, are you forced to invest equity for certain people? Like, how did you structure that? Do you have past investors that you got to deal with? Blah, blah, blah. Right? And also, are you working with like a lot of vendors? Meaning that do you rely heavily on external agencies and service providers? Or do you have everything nice and automated and taken care of in-house? Right? So that's kind of like the different factors that affects probability of your discount size and valuation. So once you understand this, right, it's time to create a big enterprise value business. So for example, if I just told you this and you realize that, oh shit, I'm definitely founder-led. Oh shit, I sell something that can be replicated like this. Oh shit, 70% of my revenue comes from Facebook and I have zero asymmetric advantages in my supply chain and all of this stuff, then guess what? You're probably going to be around the 3 multiple range, right? So once you hear that, think about like, okay, what are the things that I can do to improve that multiple? One of the biggest things actually is having automated teams. Because guess what? This is going to be the number one factor that is going to be the biggest contributor to the probability of achieving said profits. Because guess what? If you are highly founder-led as a business, then you'll probably need to do a workout, like some sort of earn-out, or implement like proper management systems in place before you're able to leave the company anyways. Otherwise, you have zero enterprise value because everything is tied to you. Like you are the value in the business. If you leave, the business is fucked. In which case, why sell, right? So this is number one thing, most important. The rest, it's kind of like optimizations, right? Because that's going to be the thing that enables you to get to like 3 to 5 million EBITDA once you have automated teams, and to really push everything else, you need to have the rest. So let's talk a bit about finding the right buyer, because obviously this is super important. Just for example, like if you give a vintage car to a scrapyard, right, they'll pay you maybe $500 for it. If you take it to a dealership, they would resell it as a car and you would get maybe $2,000 for it. But if you take it to like a vintage car collector, they will understand the true value of the car and give you the right market value for it, right? So that's why finding the right buyer is also very, very important, because your company to different individuals and different buyers is going to be of a different value, right? So think about whether you want to go down the private equity firm route or if you want to be bought out by an individual. Maybe it's a roll-up, maybe it's a branded acquisition, meaning that you're being bought out by another brand so that they can either access your current customer base, or maybe just like add your products to their product line, etc., which, you know, kind of is also a merger as well. So once you understand which one is right for you, I'm not going to talk over the pros and cons. I would literally just like ask people in the banking space or whatever that does like M&As, that like these questions and who you should be looking for and what your ideal buyer profile should be. Basically, once you identify this, you just need to get out there and start telling people your company, right? So you got to build your data room. Data room is basically just imagine all of your company stats, like your revenue numbers, profit numbers, all of everything that is about your company on the financial side, right? You put it in a data room so that it's secure. You share it with the investors and the buyers, right? And to get a higher multiple in the data room, you basically just got to convey these things. Like you got to make sure your company looks more valuable. Once you do that, it's basically just pitching, getting term sheets together, doing some negotiations. They'll go through the due diligence process. You'll probably need to renegotiate some terms, and boom, you basically sold the company, right? So last thing, this is probably one of the most important things, and I see a lot of like first-time founders or first-time business owners get kind of fucked on this, which is deal structure, right? So ideally, in the ideal world, they pay you, let's say you agree to sell the company for 5 million, they pay you 5 million with a single check and you bounce, right? It's not how it works a lot of the time, right? There's gonna be different types of ways to structure deals in order to favor the buyer, to decrease their risk, right? That you want to they want to drop their risk. So one thing a lot of buyers would do is they would first agree with you on price and then talk about the terms, right? Because the price, let's say you want to sell a 1 million EBITDA company for 5 million, right? That's fine, because that company can always be made to achieve the 5 million in profits. So what the buyers tend to do is they agree on this price, let's say 5 million, but they want to seller finance, let's say half of it, right? And have you do an earn-out of like 2 years, for example. Let me explain, right? So seller financing is basically just, let's say them paying you 2.5 mil up front, you would essentially quote unquote like finance the rest, meaning you create like a payment plan for them. So essentially it's like, you know, you would pay back, I don't know, maybe 500,000 every quarter until the rest is paid off, or maybe like 500,000 every single year, that kind of stuff. So what essentially it does is it lets you acquire a 1 million a year EBITDA business, going back to this example right here, for 2.5 million up front, right? And the rest of the 2.5 million is payable over time, right? Maybe it's a 24 or 36 month period. And then what a lot of companies try to get you with is earnouts, right? So what an earnout is basically once, let's say I buy your company, you would need to come and work for me for like 2 years, hit all of the targets in order to get your 5 million, right? So obviously these are not ideal. However, if you want to get the higher valuations, this is probably what you got to do. The biggest question to ask yourself is you need to get very clear on why you're selling the business in the first place. Like for example, if you just had a kid, right? And your business is worth 10 to 15 million, depending on the deal structure, right? Let's say, then maybe that 5 million doesn't really bring you any additional value, right? So don't always try to get the highest valuation possible, because most likely if you want the best possible valuation, you're not going to get the deal structure that you want. If you get the best deal structure that you want, you're probably not going to get the valuation. Both sides need to feel a bit of pain in order to come to the table and actually do a deal, right? So just think about it. Think about the reasons why you want to exit your business in the first place. Get clear on that so that you can use that as the principle for making decisions on deal structure and valuations. Because the difference between 10 to 12 million, yes, 2 million is a lot of money. However, is it potentially worth trading, I don't know, like another 2 years of your time to do it? Maybe not, right? So that's it on company valuations and how to sell your ecom brands for big bucks. If you enjoyed this, share this with your friends who are also thinking about exiting the company. The reason why I put out free training is because I run an email and SMS marketing agency for Shopify brands. We're really fucking good at doing that. So yeah, if you want us to handle it, book in a call with me. I'm happy to talk ecom growth in general also. So thanks for watching. See you in the next one.